Good morning, everybody. It's nice to be back, I think, for the fifth time at the National Company Congress. As Alex said earlier, I'm going to talk in a bit more detail about some of the challenges around financing international expansion, and I'll try and put it in context of some of the points that have been made by some of the other speakers this morning as I go through, and in particular in the context of the fact that we are now beginning to see a substantial shift in attitudes and expectations around the industry that I think the consensus within the industry, sensibly from the economic analysis that was presented earlier, is now to a more challenged environment in terms of oil prices, and while still fragmented, a slowly coalescing and challenged environment around gas prices as well, which won't be a smooth ride, but does look as though the entire industry is going from a position of having been fairly comfortable that trajectories were like that around price to a position where trajectories are like that, or probably like that. The other operational point that goes with that, of course, is that accompanying challenges to the top line, we've now had 5 or 6 years of challenges to the bottom line through a whole series of issues around major project overspends, major project delays, and operating cost issues. So within a position where we're moving to a market where it's going to be harder to generate cash flows, how do you manage and finance an international expansion program? And what I want to do over the next few minutes is just talk through where we believe companies' priorities lie at the moment in terms of where they are focusing their attention in terms of capital management, where they are thinking they'll raise money from for the third parties that are available as sources of finance. What are they looking for? Which ones are likely to become more or less available, cheaper or more expensive to the NOCs? And then finishing up with what can you do within your own organisations to manage both the availability and the cost of capital that you raise, not just in the short term, but also in the longer term. If I start with this rather colourful slide, every 6 months or so, we survey around 3,000 large organisations in the world and ask them a whole series of questions about what their attitude is to raising and spending money. And when we get those results in, we cut them by industry, and this is a cut for the oil and gas industry. This represents responses from about 70 players, all shapes and sizes, including national and international companies. And there's a few points I just want to make. Firstly, I think our industry, more than any other, has always governed itself via the management of capital. For as long as I've worked for the industry, which has been 25 years now, return on capital employed has always been one of, if not the key KPI. That is still the case. So everybody understands this whole dynamic about recycling capital and what's been going on over the last 18 months. Interestingly, from the highlighted block on the bottom left-hand corner, you can see we've had a continual increase in the emphasis that companies are placing on investment. And this is both IOCs and NOCs, but as Alex said earlier, the NOCs have certainly been a big player in the whole investment landscape, whether it's capital expenditure, whether it's M&A activity. Interestingly, at the same time, they seem to have become a lot less interested in raising capital to finance that investment, which is the box on the bottom right-hand corner. So where is the money coming from to finance this? And the answer on the next slide is basically what we call on this slide cash, but you can also describe as internal operating cash flows. Why has that been the case? and is it durable? It's been the case primarily because the oil price has been north of $100. And if you're an operating oil company of any size with producing assets, when the oil price is over $100, you should be throwing off a lot of surplus operating cash flows. Companies in this sector have tended to use that as their first port of call for financing. And one of the features of this sector is that in the same way that it's very comfortable with taking on fairly high operational risks and engaging in a sort of a very risky industry in some fairly risky locations, it has not historically been a sector that is comfortable with financial risk. And most of the companies, especially the larger ones, have traditionally been very conservative about how they manage their balance sheets and the level of external funding that they take on. And I think this ultimately derives from the fact that anybody who's been in this industry for a long time understands the way cycles work and understands that you need to keep your options open because prices can change very quickly and your cash flow profile can change very quickly as well. In terms of the other sources of finance, where have people been going? Surprisingly less so to debt over the last 18 months and slightly more over equity. We don't think that's representative of what things are going to look like going forwards. Going forwards, we believe that the level of operating cash flows will become more challenged and that all companies, including NOCs, will need to look for external finance. And within that universe of potentially available external finance, we believe that debt is more likely to be the one that is the first port of call than equity, simply because there are quite a few constraints on NOCs raising equity due to restrictions over control, etc., imposed by their host government, combined with the fact that host governments, especially in this day and age, don't have a bottomless pocket to finance every claim on their resources. If we go into more detail into where the financing might come from, we listed some popular ones on this little chart. If I look at the top block, the debt block, the one that's been most popular for the last 18 months, I think has definitely been corporate level bond finance. And those of you that sort of keep up to breast with these matters will know that we are in the middle of what's variously described as either a very strong bond market or a bond bubble. What that means is that there has been no shortage of fairly cheap bond financing available for oil companies of all stripes, and the NOCs, amongst the other oil companies, have made extensive use of this to finance both organic and inorganic expansion. And over the last 12 months or so, some examples: we've had Petrobras raise $11 billion, CNOOC raise just under $4 billion, ostensibly to finance the Nexen deal. We've had Sinopec raise $3.5 billion to finance international expansion. We've got ONGC in the market at the moment seeking to raise money to finance its international expansion. That's definitely been where the centre of gravity lies. Interestingly, across this whole industry, and with the NOCs in particular, the industry is not anywhere near as great a user of things like project finance as some of its peers in terms of asset-intensive infrastructure-based industries. So, for example, the use of project-based finance is far more widespread in power and utilities than it is in oil and gas, despite the fact at face value many of the projects have not dissimilar features. As we go forwards, what do we think is going to happen? As we come out of the underpricing of debt, which will likely happen at some rate over the next 3 to 5 years, then we'll probably see a fairly choppy ride in the bond markets as that process goes on, as unfortunately they won't move smoothly in any direction. This will put some pressure on companies to think more creatively about how they're going to raise finance. We're already seeing some examples of that. Project level finance, partnerships, maybe one way to go. Trade or forward sale finance may be another way to go. We did see Rosneft finance at least part of the TNK-BP transaction through some very creative forward sale-based finance. But I think for the broader NOC community, you need to think about why you're doing the internationalisation. If you're doing the internationalisation to develop a physical hedge, and a sort of physically based price hedge for future consumption, then it makes relatively little sense to tie yourself into a fixed price profile via forward sales. So I think there's going to be some innovation around this whole area over the next couple of years, and I think a lot of it will focus around the project level finance. On the equity side, as I said earlier, there are restrictions around what a lot of NOCs can do just by the fact that governments wish to retain control, whether that's control via a golden share or whether it's controlled by majority ownership. It does place certain restrictions around access to capital markets. And I think that's going to be with us for some time to come. However, equity can be raised at a project level, and the industry has been raising equity at the project level for the last 100 years because that's effectively what a joint venture is. So we may see more of that coming up as well. What are the providers of capital looking for? They're all looking for roughly the same things, though the emphasis they place varies depending on whether they are equity or debt, and whether it's asset or corporate level. Broadly, obviously, debt providers are much more defensive in their outlook. They're more interested in understanding that they will get definitely the cash flows they think they're going to get, rather than equity are much more growth-oriented and much more relaxed about deferred satisfaction rather than immediate repayment. From the asset versus corporate level, at the asset level, they're looking for very granular access to cash flows. Once you go to the corporate level, it becomes a lot more complicated, and it becomes much more down to governance, communication of strategy, all that kind of good stuff. And I think one of the key words in all of that is communication. And I think this was another point that was raised earlier, is that as soon as you raise money from anybody, they become a stakeholder in your business. All stakeholders like to be spoken to. I think what's possibly not understood quite so much in this process is how variable they are in terms of their level of understanding and what kind of impact that can have. When we talk to the investment community that invests traditionally in this sector, what they tend to value is how predictable it is. Not in terms of net cash, because that's very dependent on volatile pricing, but in terms of how easy it is to get from a oil price to how much money oil and gas companies throw off. That predictability is one of the industry's core strengths when it comes to raising finance, and I think it's essential when developing your communication programs with the finance providers that you work to make yourselves as predictable as organisations as possible. And in particular, if you're undertaking a fairly major change, such as switching from a primarily domestically oriented company to a global company or an international company, then that does come with a fairly high burden of explanation and communication in order to manage the cost and availability of capital that you're going to get. I think the other point I'd make on that is that the investor community is both very varied in its current understanding of the industry, and from talking to quite a lot of them are nowhere near as sophisticated in their understanding of the industry as you might think before you talk to them, but also they change. They change their levels of understanding constantly, both as organisations and also as individuals. And I think one of the important things to remember at the moment is that within the organisations that you raise finance from, there's probably never been a greater level of churn. So the need to continually re-educate people within that is definitely with us. Why is it important? It's important because if you don't communicate, your providers of capital can't understand risk, and if they can't understand risk, they can't price it. It's a common fallacy that investors don't like risk. Investors actually need risk. If there isn't any risk, there isn't any return. What investors don't like is uncertainty or unquantifiable risk, put in another way. So this means that within the investment community, there's a range of potential outcomes. Either they won't understand the risk of your project or your organisation at all, in which case they simply won't be able to invest. They will misunderstand it, in which case they will invest but on the wrong terms. And you could argue actually at the moment that a lot of the bond money that's being made available is based on a misunderstanding, not necessarily of industry risk but global risk. Or if they understand it properly, they'll price it right. Now, you may think that it's a good thing if you can get them to price it wrong on the downside, and indeed it can be in the short term, but as an industry where our investment life cycles are often 10, 15, 20 years, and we continually need to access capital, then we would argue that having a stable position within the markets where you are well understood and considered to be predictable, in the long term lowers your cost of capital and increases its availability. So I think I'm just about coming up to time. So I'll finish there with a few sort of finishing points to take away. One, in addition to thinking about your international expansion strategy, also think about who you would like to target to finance it. Not all providers of finance are the same, not all sources of finance are the same. You can save yourselves a lot of pain and a lot of money by getting that targeting right. Secondly, do invest time in both working out how you're going to communicate with those people and continually reassessing that as you communicate with them to ensure that you de-risk their perception of your investments as much as possible. Thirdly, build relationships. Relationships help greatly when things go badly in the markets in terms of where you sit in the overall priorities of various finance providers. And lastly, in listening to your sources of finance, whether it's your host governments, whether it's third parties, don't be afraid to change your strategy, and don't be afraid to change the mix of financing both at the project and corporate level. The final thing I would say, which is a positive note, is that this is considered to be one of the most financeable industries there is. So there's nearly always capital available at some price. I think the challenge that we will all have over the next 5 to 10 years is ensuring that remains the case as we move through a period of some volatility in pricing and costs. Thank you.